What's going on, guys? Thank you so much for clicking on the video. If you're new on the channel, my name is Daniel. I'm a fairly new investor. I'm into dividend stocks. I like to share my journey as I learn and as I find out different things about the stock market. And if you're into that kind of stuff, consider hitting the subscribe button, hitting the like and bell notifications button so you get notifications every Monday and Friday when I post. So I recently got braces right here. So if I sound a little funny, then I'm sorry. I'm trying to get used to it. I've only had them for about 2 days. So again, if I mumble or the words don't come out or they don't sound right, I apologize in advance. Just giving you a heads up. Something that I want to talk about is average cost. Now, this is something that I've been looking at. I haven't seen too many YouTubers talk about it. I feel like right now with the market doing everything that it's doing, going up, down, one day is 20% up, the next day you look, it's like 30% down, the next day is like 30% up, and it's so crazy. I believe average cost is something that we should be looking at if you are looking into long-term investing like I am. For example, with my dividend investments, average cost is something that I look at, not all the time, but in certain cases I like to look at it and see how I can benefit from the market being the way that it is right now. For the purposes of this video, I want to use Wells Fargo, which is one of my favorite dividend investments. I want to show you exactly what I mean. So you can see right here, I own 6.97 shares. I have a market value of $178.31. This is what I want you to look at right here, the average cost. So the average cost for my stocks, for those 6.97 stocks that I own of Wells Fargo, I paid an average cost of $27.29. Now, this has balance. When I first bought my 4 stocks of Wells Fargo, I paid $27.64. This is what I mean when the stock is down, that we should be looking at the average cost to increase our portfolio. And when the market goes back up, then the average cost will be low, the stocks will be high, and then if you decide to sell, then you will get more money and your investment won't be as high. What do I mean? Stick with me here because I'm trying to simplify it as much as I can and trying to explain it to you guys as best as I can. I'm no expert in this subject, but if you get what I'm saying, trust me, it will make perfect sense, and once you put it into practice, you'll be glad you did. So again, as you can see here, I have 6.97 shares of Wells Fargo with an average cost of $27.29. Now, I'm gonna add 2 more shares because the price is low right now, and you're gonna see the average cost lower. So we're gonna go ahead, we're gonna add 2 shares. I'm not gonna share my bank account or none of that, so I'm gonna stop it right here. Then order completed, and then you can see here my average cost dropped after adding those 2 shares, and now I own 8.97 shares. And if you see over here, the average cost lowered to $26.91. What does this mean? I'm gonna try to explain it as simple as I can. If the stocks that you are invested in right now, you are not planning on selling them anytime soon, or even if you are planning on selling them, but it has dipped a little bit, let's say it has dipped 10%, you know, for example, for me, every end of the month from the 25th to the 1st, I start looking at stocks that I want to get invested in. I want to see what stocks I want to add to my portfolio. I usually do it from the 25th to the 1st of the month. Today, I happened to see that Wells Fargo was dropping. It was running at an average of $25.33, something like that. Instead of waiting, and what some people might consider a bad time to invest, since I know I'm gonna keep my Wells Fargo shares and I know I'm gonna have them for the long run, instead of waiting, you know, or selling my stocks, I'm gonna go ahead and add 2 more shares because this is one of those stocks that I'm gonna have for the long run. And since I'm getting it at a cheaper price than what I paid for originally, that's when the average cost drops. And that's when, once Wells Fargo balances out and let's say it goes back to $30 or it goes back to $52, which it was the 52-week high, then my profit, if I decide to sell it, is gonna be a lot higher than if I would have stayed with the original purchase of 4 shares that I originally started with. I wouldn't have made that much profit. In recap, I bought my first 4 shares at $27.64. I bought 2 more shares about a month ago at $26.62. Today I'm adding 2 more stocks at an average of $25.33, which brings my average cost down to around $26.91. And when the time comes for me to sell Wells Fargo, the profit will be more because I paid less, I lowered my average cost, which brought the price down. If you are following me, give me a thumbs up. I know there's a lot of rambling going on right now and it might not make sense. You buy at a certain price for whatever stock you have, you wait for the price to go low, you keep adding to your portfolio. If you want to wait, whatever your strategy is, you wait for the price to drop a little bit more, then you keep adding to your portfolio. That is how you will lower your average cost, and in the end game, whenever you decide to sell, you'll still make a lot more profit than if you would have just stayed with whatever you purchased at the beginning and didn't add more because the market is crazy. Hope that made sense. If it didn't, let me know below. below, or if you're a seasoned investor, then let me know a different way or simplify the average cost strategy. To give me your input on why you think I should change, what I should add. Again, thank you guys so much for watching the video. If you enjoyed it, give me a thumbs up, give me a drop and like or comment, and see you on the next one.